Hey everyone, Trevor here with the Trev and Jess team of Love It Properties. I'm jumping into part 2 today of our talk that we started last week about interest rates. Okay, the weather was gross this weekend, but it's gorgeous today, so join me for a walk as we continue to talk about this really important topic. A really common question I bump into all the time is your mortgage interest tax deductible? And the answer is yes. Every year, whatever interest you pay on a primary home mortgage loan is tax deductible, as long as your loan is less than $750,000. This is a huge advantage when we have higher interest rates like we do now, because you're getting a higher deduction. Granted, you have to have some room for that deduction. Another common question is, are there easy ways to lower your interest rate right now? Absolutely. With interest rates being so high, sellers are seeing a lower than usual demand for their listings. And so a lot of them are willing to concede cash in order to help you buy down your interest rate. As the spring market heats up, it's going to become increasingly difficult to negotiate any concession from a seller. However, I would still highly recommend looking into these buy-down programs that we talked about last week. Some of these can temporarily buy down your loan for the first couple of years that you have it, or some of them can lower it for the life of the loan. Lenders would all concur. Doing these buy downs are going to save you a lot more money than putting a larger down payment. The down payment affects your payments very little over the course of 30 years. However, a buy down can dramatically affect your monthlies for the first couple of years that you're living there. That's a better savings, and it helps you wait out when you can refi in the future and get a lower fixed interest rate for the life of the loan. Probably the top conversation I'm having with people in relation to interest rates is, where do I think they're going in the future? Now, I don't have a crystal ball, but I can look at trends that have happened in the past, and what seems to be true is every time the Fed tries to counter inflation by raising rates, it throws the economy into some kind of recession. And what we're seeing right now are those layoffs and that type of recession in our economy. When that occurs, what do? Since they've overcorrected, they have to drop rates again in order to help the economy. And so I think probably if the trends continue, that's what we're going to see before the end of this year. Now, rates probably won't go back down to the historic lows that we've seen in the 3s and 2s, but odds are we might see some 4s or 5s before the end of this year, and maybe even lower next year. So we can all hold out hope that maybe we'll see a drop relatively soon. I think it's a pretty high likelihood that's going to happen. But here's the thing. Don't wait on interest rates to drop to purchase. If you do, the house prices will jump with them because we're seeing limited inventory right now. So the moment rates start to come down, you can expect you're going to have to pay more for a house, which is why you need to jump in sooner than later. All right, guys, well, that's all I have for today. Thanks for tuning in, learning more about interest rates, and I hope that this has answered some of your questions and helped you out as you're thinking through this process of what it might take to purchase a home right now or refinance or whatever your needs are related to interest rates. All right, guys, thanks for joining. We'll talk again soon.